Welcome to While We Were Distracted, the podcast where we explore topics that often get overshadowed in the rush of daily life.
Imagine buying shares in, the greatest space exploration company in human history.
Right, the one that routinely lands massive rockets on floating drone ships.
Exactly, a company promising to make humanity multiplanetary. But then you actually look at their IPO paperwork and realize you just bought an AI data center startup.
Yeah, it is a massive reality check.
Okay, let's unpack this. Welcome to the deep dive. Today, we are opening up the colossal 400-plus page S-1 prospectus that SpaceX filed on May 20, 2026.
Just ahead of its massive mid-June NASDAQ Q debut.
Right. And our mission today is to look completely past the sci-fi headlines and figure out exactly what kind underlying business actually commands a $1.5 to $2 trillion valuation.
Which is an astronomical number.
It really is. We've gathered some incredible reporting from Fortune, AP News, The Economist, and Barron's to help us navigate this. Because frankly, the reality of this company is entirely different than the public perception.
The sheer scale of the numbers we're dealing with here really requires a total reset of how we think about public markets.
Oh, absolutely.
The expectation is that this IPO will raise somewhere between $75 and $80 billion.
Wow.
Yeah. That single event will make it the largest IPO in human history, likely cementing Elon Musk as humanity's first trillionaire.
That's just wild to think about.
But the most jarring takeaway from spending hours reading through that dense legal and financial filing is that the core engine of this valuation has very little to do with traditional space exploration.
So if they aren't selling tickets to Mars, what exactly is the business model here? Because everything you hear about SpaceX is about rockets and satellites.
You have to look at what they're projecting for their total addressable market, or TAM.
Okay.
Basically, this is the company telling potential investors, here is the size of the total pie we plan to eat from. SpaceX is projecting a TAM of $28.5 trillion.
Trillion. With a T.
With a T. But here's the kicker. 93% of that figure, $26.5 trillion, is attributed entirely to artificial intelligence.
Wait, really? 93%?
Yeah. Back in February of 2026, SpaceX effectively executed a merger with xAI, Musk's artificial intelligence venture.
Right, I remember that making the news.
Exactly. And what they're pitching to Wall Street now is a concept they call Orbital AI.
Wait, Orbital AI, that sounds, it's like investing in a world-famous pizza shop because you love their pizza, only to read the fine print and realize they're actually planning to make 93% of their money by selling the ovens.
That is a perfect analogy.
How does an Orbital AI business even function? Are there just servers floating in space?
What's fascinating here is that it sounds like pure science fiction, but it's engineered to solve very real, immediate bottlenecks happening down here on Earth.
Like what?
Right now, the AI boom is running into a physical wall. Data center developers are out of power, and they are out of land.
Oh, because these facilities take up massive amounts of grid space.
Exactly. You can't just plug a massive gigawatt AI training facility into a local grid without browning out the surrounding city.
Right, the power grid just can't handle it.
So SpaceX is proposing a workaround, launching the compute infrastructure into orbit. Up there, you have access to uninterrupted 247 solar power.
Oh, because there are no clouds and no day-night cycle.
You got it. And furthermore, they plan to use the near absolute zero temperature of space as a natural heat sink,
bypassing the need for all the water cooling. I know terrestrial data centers consume millions of gallons of fresh water.
Exactly. And then the data is just beamed back and forth to Earth via advanced laser communications.
Okay, I hear the physics of that and the potential to bypass local zoning boards and power grids, but my skepticism radar is flashing red right now.
As it should be.
If they are making a pivot of this magnitude, they are completely changing their weight class. They're no longer just competing with legacy aerospace contractors like Boeing or Lockheed Martin.
Yeah, no, they are actively declaring war on the hyperscalers.
Right.
And when we use the term hyperscaler, we're talking about the absolute titans of tech. Microsoft, Google, Amazon Web Services, and specialized giants like CoreWeave.
The companies that basically run the internet.
Exactly. These are companies that operate data centers at a scale that dictates the global market for compute power. Let's put that $26.5 trillion AI market projection into perspective.
Okay.
The entire gross domestic product of the United States, every good and service produced in the country in a year, is about $31.9 trillion.
So SpaceX is basically telling investors that their AI segment alone is targeting a market almost the size of the entire U.S. economy.
Yes. And when you project a market that massive, you're guaranteeing the most brutal corporate competition imaginable. Every single tech monopoly on Earth is fighting for those same dollars.
Yeah, Microsoft isn't just going to roll over and let them have it.
Not at all. To stay in a race against Microsoft and Google, you can't just have good ideas. You have to spend an absolute fortune just to keep your seat at the table.
Which has to exert immense downward pressure on their profit margins. So if they are suddenly going to war with Microsoft and Google over a $26 trillion market, they can't do that on a scrappy startup budget. How on earth are they bankrolling that kind of compute power? Building AI infrastructure on Earth is notoriously expensive, let alone trying to blast it into orbit.
Well, the short answer is they're bleeding cash.
Really?
Oh, yeah. For all the massive success of their reusable rocket launches, the consolidated company is deeply in the red. The filings show that last year they posted a $2.6 billion operating loss on $18.7 billion in revenue.
Wow. $2.5 billion in losses.
And the AI segment is a cash furnace all on its own. Over the last 5 quarters, they've suffered $8.9 billion in operating losses just in AI.
Why is it burning so much? Is that all research and development for the orbital lasers and space servers?
Not even close.
Yeah.
A huge portion of it is simply trying to build the terrestrial foundation first.
Oh, so building stuff on the ground.
Right. Before you put a data center in space, you have to train the AI models on Earth, and that requires physical infrastructure and hundreds of thousands of extremely expensive GPU chips.
Oh, man. Those chips are not cheap.
No, they aren't. In the first quarter of 2026 alone, their AI capital expenditures hit $7.7 billion.
In one order.
In one quarter. They are currently building out the Memphis Colossus facilities, which covers 2 million square feet, and they are dropping another $20 billion on a new hyperscale center in Mississippi.
So they're basically funding all of this heavy Earth-based infrastructure before they even attempt to solve the engineering hurdles of orbital AI.
Exactly. It's a massive upfront cost.
What about Starlink, though? Because satellite internet seems to be the one product everyone actually uses and understands. Does it help offset the AI spending?
Honestly, Starlink is the only thing currently keeping the lights on.
Okay, that makes sense.
The connectivity segment is a real money spinner right now. They've crossed 10 million active subscribers. Last year, that division generated $4.4 billion in operating income.
That's a huge number.
It is. It translates to a very healthy 30% profit margin.
But even with 10 million people paying for the service, there has to be a ceiling, right? It seems like the financial filings show some stress fractures in that model.
Yeah, they do. The problem is terrestrial competition. The metric to watch here is average revenue per user.
Okay.
In 2023, SpaceX was pulling in about $99 per subscriber. By the first quarter of 2026, that number dropped to $66.
That is a significant drop. Why is that happening?
When Starlink first launched, they largely had the rural, disconnected market to themselves. People were happy to pay premium prices to finally get decent speeds.
Right, if your only other option was dial-up or nothing.
Exactly. But now, telecommunication companies are laying fiber optic cables deeper into suburban and rural areas. And you also have 5G fixed wireless access from companies like T-Mobile.
Oh, offering reliable home internet without the need to mount a bulky satellite dish on your roof.
Precisely. To compete with those faster, cheaper terrestrial options, SpaceX is mechanically forced to lower their subscription prices.
I see. So their only profitable engine is seeing its revenue per user shrink at the exact same moment their AI cash furnace is getting cranked up.
You hit the nail on the head.
But wait, here's where it gets really interesting. If they need cash, what about the $80 billion they're about to raise in the IPO? Looking at this from the outside, you'd think that a massive influx of cash would easily cover all these AI data center costs, right?
You would think so. But a report from the financial research firm New Constructs dug into the fine print of the S-1 and uncovered something startling.
What's that?
78% of those expected IPO proceeds, roughly $62.8 billion, is already pre-pledged to pay third parties.
Wait, pre-pledged? As in, the money is spoken for before the stock even hits the public market?
Yes. It is legally earmarked for debt repayment.
You're kidding.
I wish I was. A massive chunk goes to early private investors. Another portion is dedicated to paying off creditors of X Corp, the social media platform, and settling the outstanding debts of XAI from before the merger was finalized.
Oh, wow. So they're using the SpaceX IPO to basically clean up the balance sheets of his other companies.
Essentially, yes. Once all those specific corporate debts are cleared, it leaves less than $18 billion for actual growth in capital expenditures.
But you just mentioned they spent $7.7 billion on AI infrastructure in a single quarter. $18 billion is going to evaporate in less than 9 months at that burn rate.
It will. And the company is actually quite transparent about this reality. On page 53 of the S-1 prospectus, there is an explicit warning to investors.
What does it say?
They state they expect a multi-year investment horizon before the AI segment turns any profit whatsoever, and they warn that capital expenditures will scale up rapidly during that window.
So cash is incredibly tight. The AI pivot will take years to become profitable, and despite all of this, the valuation is sitting at a staggering 93 times trailing sales.
Which is astronomical.
Right. And just to ground that piece of financial jargon for a second, that means if the company never grew again, it would take 93 years of their current sales, not profits, just raw sales revenue, to equal the price tag of the company today.
Yes. To justify a $1.5 trillion valuation, analysts estimate they'd need to book $189 billion in pure annual profit by 2035.
No U.S. company is currently doing that. With margins that tight and expectations that high, what kind of power do you actually get as a shareholder buying into this?
Practically none.
Really?
Yeah. This brings us to the governance structure and a phenomenon financial analysts call the mega IPO curse. If you buy shares in this offering, you're essentially strapping yourself in as a passenger with no access to the steering wheel. Musk will hold 85.1% of the total voting power.
Ah, because of the super voting shares.
Exactly. The Class B shares are structured to give him 10 votes for every single share he holds, compared to the 1 vote per share the public gets. Mechanically, this means he cannot be removed by a shareholder vote, no matter how the company performs. He is entirely free to name a board of directors dominated by insiders.
Okay, let me play devil's advocate for the listener here, because the FOMO, the fear of missing out, is incredibly strong with a company like this.
Oh, absolutely.
I mean, this is the most famous private company in the world. They launch 3/4 of all active satellites in orbit. They're building the infrastructure for the next century of spaceflight. Why wouldn't someone just buy in on day one, regardless of the voting rights? People want a piece of the future.
That underlying sentiment is exactly what the early private investors are banking on.
What do you mean?
Well, in the private equity world, there is a concept called exit liquidity.
Okay.
The early investors who took the massive initial risks years ago, firms like Blue Owl Capital, who actually already secured a 10 times return by selling half their stake in private markets, they're eager to cash out the rest of their chips.
Right. They want their payday.
Exactly.
Yeah.
To realize those billions of dollars in paper gains, they need a wave of new buyers. They need you, the public, to provide the cash so they can exit.
Wow.
And history tells a very grim story about these massive, highly hyped mega IPOs. If you look at U.S. public offerings over $15 billion, excluding one recent outlier, only 17 out of 36 have generated any positive returns whatsoever.
That's less than half.
Right. And only 9 of those 36 managed to beat the S&P 500 benchmark.
So only 9 out of 36 beat the broader market over time. That is a terrible track record.
It is. On average, over the last decade, despite the initial excitement, the first day pop, which usually averages around a 23% gain, these massive stocks end up lagging the broader market by 25 percentage points over the next 3 years.
Why does it always drop like that?
The mechanism behind this drop is the expiration of the lockup period.
Ah.
A lockup period is a legally binding time frame where early insiders and employees are forbidden from selling their stock, usually to prevent a mass sell-off on day one. For most SpaceX insiders, that period is 180 days.
And for Musk?
It's 366 days. When those dates hit, there is a massive waterfall of stock suddenly available in the open market as those early investors finally crystallize their gains.
And that sudden, enormous increase in supply mechanically drives the stock price down.
Exactly.
Okay, so what if a listener hears all this, looks at the governance risks, looks at the cash burn, and decides, you know what? I'm going to sit on the sidelines. I'm not going to buy the IPO. I'll just wait.
They avoid the risk, right?
Not necessarily.
Wait, what?
This is where the mechanics of modern investing create a trap. You might still end up holding the bag, entirely by accident because of how your retirement accounts function.
The index fund trap. Yes, this part of the reporting is completely wild. Explain how this mechanically forces people to buy.
It comes down to market cap weighting. Because SpaceX is debuting at such a massive valuation, approaching $2 trillion, major market indexes are fast-becking their inclusion into the core indices.
Standard & Poor's is currently proposing a shortened 6-month wait for inclusion in the S&P 500. NASDAQ just cut their waiting period down to a mere 15 days.
Just 15 days.
Yeah. And when a company is added to an index like the S&P 500, it ceases to be an optional investment for the broader market. Index funds are essentially mechanical recipes.
Right.
If you have a 401k, a pension, or an automatic retirement savings plan with a firm like Vanguard or BlackRock, a portion of your paycheck automatically goes into those funds.
I see where this is going.
The moment SpaceX is added to the index, the algorithms running those funds are legally required to buy the stock to match the new recipe, regardless of the price, the underlying fundamentals, or the S-1 risks.
So millions of regular people, through their passive retirement accounts, are automatically forced to buy SpaceX stock at these potentially highly inflated early prices.
Exactly. It's a massive forced buy-in.
It's basically like getting a highly coveted invite to an exclusive VIP party, only to walk in and find out you were invited specifically to pay the bar tab for the billionaires who are already leaving out the back door.
That analogy perfectly captures the wealth transfer dynamic at play. Consumer advocacy groups are raising major red flags about this exact mechanism.
I can imagine.
And to add another layer of complexity to the governance issue we discussed earlier, as a forced public shareholder, your retirement money is now exposed to a company that spends wildly within its own CEO's ecosystem.
Blurring the lines of traditional corporate boundaries.
Yeah. For example, the S-1 revealed that in 2025 alone, SpaceX spent $131 million just buying Tesla Cybertrucks.
$131 million on Cybertrucks. That isn't exactly a rounding error, even for a company this size.
No, it really isn't.
So given all this, the forced buying, the cash burn, the massive pivot to AI, what is the actual strategic takeaway for someone trying to navigate this?
Well, if we connect this to the bigger picture, the consensus advice from financial media, particularly highlighted in Barron's, is extreme patience.
Patience, okay.
If you truly believe in the company's long-term vision, whether it's Orbital AI or global satellite dominance, the recommended strategy is dollar cost averaging.
So buying small set amounts of the stock over a long horizon.
Right. And most importantly, waiting for the post-IPO dust to settle. Barron's uses the Meta IPO as the perfect historical parallel here.
How does that compare?
If you bought Meta on day one of its highly hyped, chaotic public offering, you weathered a lot of immediate volatility, but you were still up a very respectable 1,474% today.
Okay, not bad.
But if you patiently waited just 6 months for the initial hype to die down, the index inclusions to stabilize, and the early insiders to finish dumping their stock, your gains today would be 2,454%.
Oh, wow. That's a massive difference.
Patience pays massive dividends when it comes to mega IPOs. Let the market digest the reality of the business first.
So let's synthesize all of this for the listener. The public perception of SpaceX is deeply rooted in the romance of space exploration and reaching the stars. But the financial reality, the actual S-1 document itself paints a very different picture. It reveals an AI data center startup burning billions of dollars to fight a ground war with Amazon and Google, all of which is subsidized by a satellite internet business that is slowly losing pricing power to terrestrial 5G and fiber networks.
Spot on.
And it's a company entirely controlled by one individual, floating an IPO structured largely to pay off old corporate debts, and it is priced for absolute flawless execution over the next decade.
Flawless execution of a business pivot that has almost no precedent in corporate history.
Right. Now, before we wrap up with all this focus on artificial intelligence, terrestrial data centers, and financial maneuvering, does the actual paperwork say anything about space exploration anymore? What happened to the Mars mission?
Oh, it is in there. But it appears as the ultimate financial catch-22, buried deep in the details regarding Musk's ultimate compensation package.
Oh, really?
Yeah. To unlock his final maximum payout, a tranche of stock options that requires the company to hit a $7.5 trillion market capitalization.
Mm-hmm.
Musk must successfully establish a 1 million person colony on Mars.
Wait, 1 million people living on another planet just to trigger a compensation package?
Yes.
That is insane.
It leaves us with a truly unprecedented puzzle to chew on.
How so?
Well, think about it. If SpaceX actually manages to pull off this multi-trillion-dollar AI pivot, if they leverage Starlink to dominate global connectivity, and if they use all of those profits to successfully build a self-sustaining city on another planet just to fulfill a CEO's contract,
Yeah.
what does it actually mean for the future of humanity when a single publicly traded corporation, legally bound to maximize shareholder value, essentially becomes the sole government, the sole utility provider, and the sole landlord of an entire world?
Wow. That is the ultimate existential question hidden at the bottom of a financial filing. We're no longer just trying to value a tech company, we're trying to price the initial public offering of a completely new civilization. And we'll just have to wait and see what the market decides that is actually worth. Thanks for joining us on this deep dive into the SpaceX S-1. Keep questioning the headlines, and we'll see you next time.
Don't forget to like and subscribe for the next episode on While We Were Distracted.